بسم الله الرحمن الرحيم. الحمد لله والصلاة والسلام على نبينا محمد وعلى آله وصحبه أجمعين. السلام عليكم ورحمة الله وبركاته. Welcome to lecture 3. Today's topic is debt policy. This chapter analyzes several possible financing scenarios and provides an overview of the effect of taxes and costs of financial distress on a firm. So, what we are going to cover today is debt policy. So, how companies choose their debt or debt policy. Is it good to finance our activities using debt or not? Okay, when we say debt, so as a finance student, when we say using debt to finance our activities, we mean loans or bonds. So always remember this. Whenever I say debt, it means either bonds or loans or both. So the companies have the option to take loans to finance their activities and investments, to expand or to issue bonds, which are several shares but have different characteristics, which is covered in other unit. So we have bonds and shares. So today we will see why companies use debt to finance their activities. Why not just rely on equity, which is share? Okay, so we will talk about the several possible financing scenarios. At the end, we will talk, inshallah, about the effect of taxes on financing and the cost of financial distress. Okay, let's start. The first question: does borrowing or taking debt affect value? We mean here the value of the company. Does borrowing or taking a loan affect the value of the company or not? We will answer this one through the whole lecture, inshallah. So we will start with something called propositions, okay? Actually, this related to two finance and economic scientists in 1958. Actually, they introduced some theory. They call it propositions. So the first one, propositions, which is actually mentioned in the next slide, but this is just introductions here. They said a company's choice of a capital structure does not increase the value of the firm. Now, when we say capital structures, it means how you finance your activity, which capital you use, which money. Do you use equity or debt, or a mix of debt and equity? So those guys, what they find, they said whether to use debt or equity, this will not affect the value of the company. It is up to you as a manager. You can use debt, you can use equity to finance your activities. But we will discover at the end of this lecture, this is not true. Actually, it's not true. So this is just like we will learn how to go step by step from propositions 1 to propositions 2. Okay, here in the slide, nothing in the table. This is just balance sheet. We know this is the accounting equation. We know asset should equal liability plus owner equity, right? So we are not covering this here. It is an accounting. So always, if you see any balance sheet for any company, always the left side should equal to the right side. All assets, the value of the asset should equal the value of equity and liability. Okay, we will start with that M&M, irrelevance propositions. As I said, Modigliani and Miller in 1958, they introduced this theory. They call it a propositions or suggestion 1. What they said: the value of the firm does not depend on the capital structure. So the value of the company doesn't depend on how you raise money to finance your activity, which means the value of leverage firm. L means leverage. Leverage means the firm that use debt. So the value of a firm that use debt, a value of leverage equals the value of a firm that is unleveraged, that they don't have any debt. So if you open any balance sheet for a company that has zero debt, the value for that company is equal to another company that has debt. This is how they introduce this theory. So this is, we call it propositions 1 and M. So you need to remember this one. This is a first propositions. Now, if there is a proposition or suggestion that is correct, can financial managers increase the value of the firm by changing the mix of debt and equity, which are security used to finance a company? The answer is no. So, according to them, if whether you use debt or equity doesn't affect the value, it means as a financial manager, I cannot use this tool. I cannot use the financing structures to increase my value because they said there is no value for it. However, for these propositions, here are many assumptions. So, when they derive this formula or when they derive this theory, they rely on several assumptions. They assumed the capital, or we have a well functioned capital market. So, the capital market is very good, okay? It is well functioned. They assumed also efficient capital markets, which means all the information that is available is reflected in the prices of the stock. So if there is a bad news, it's already reflected in the price. The stock will go down. If it is good news, it is already reflected. So this is what they assumed. Okay, they also assumed we don't have any tax. They also ignored the cost of financial distress. When we say financial distress, it means the cost of collapsing the firm or liquidity or bankruptcy. When the firm goes bankrupt, so they lose money normally, right? We will talk about this later on, inshallah. So for now, you can see they put many assumptions here in order for them to derive this theory. But those assumptions, if you look in real life, we don't have them, right? In real life, we have taxes. In real life, there is a cost of collapsing for firms. In real life, we don't have fully efficient mark. We have maybe semi-efficient, but not efficient. We don't have a well-functioning capital market. Now let's approve their propositions by numbers. Here we have examples that show you what they said is correct in case we don't have tax. Example, an all equity finance firm has 1 million shares outstanding, currently selling at $10 per share. It considers restrictions that would issue for millions in debt to repurchase 400,000 shares. How does this affect the overall fair value? So, what we have here, assume we have a company or a firm that is all equity. When we say all equity, it means they only use shares to finance their activities, which means in their balance sheets they have zero debt. Okay, assume a company that has zero debt. It is all shares in the balance sheet, and this company, they have 1 million shares outstanding, number of shares in the market, 1 million. This is a number of shares, not a dollar amount. How many shares? 1 million. Currently selling at $10 per share. So the price of each share is $10. They want to restructure the company, and as a result of restructurings, they want to issue 4 million debt. So they want to issue 4 million bonds, and the money from the bonds, they are going to use it to repurchase their own shares from the market. Okay, like we know, each shares $10. They want to buy 400 shares. It will cost them 4 million. So it's like they took debt in order to buy their own shares from the market, and they can do it. Normally the company they do that. Okay, so we want we want know to know now how this affect the firm value at the end? Okay, always when you have those type of questions, you need to put before restructurings and after restructuring. Okay, before restructuring, the value of the firm, we know the value of any company is equal to the value of equity plus value of debt, right? You remember from here, this slide, the value of the firm. If you add debt plus equity, you will give you a firm which is equivalent to value of assets. But now, actually, in these equations, we are interested in the right side, the value of debt and equity. So, based on these equations, how much equity we have for this company before restructuring, they have 1 million share, each of them 10, right? 1 multiplied by $10, it means 10 millions. So there is no debt at the beginning, right? The first scenario, there was no debt, zero. So 10 million shares, which is 1 million multiplied by 10. This will give you the value of the shares or equity plus zero. The value of the firm is 10,000. So this is before structuring the company. Now, in the second part, after the restructurings, okay, they have now 4 million. What? Debt. They mention it in the questions. They want to issue 4 million debt, right? So in their balance sheet now they have 4 million debt plus how much equity? Equity we have now less than 10 million, not 10, right? We have 6 million only. And why is that? Because we said in the questions, this debt, they use it for or to buy shares, right? They want to buy 400 shares from the market. 400 each of them $10. It means 400,000 reduced from the market. They bought it already. So a number of shares now or value of equity is 6 million instead of 10 because they bought for millions from the market. But at the same time, they took debt for million altogether. Okay, it's like so you can see here before structuring the value it was 10 million because debt was zero. After restructuring, they just like move it from equity to debt again. The total is 10 million. So this is what they suggest those guy, the value of the firm with no debt, which is a first scenario here, and unleveraged firm is equal to the value of the firm which is leverage that use debt. Let's talk now about EPS, how borrowing affect earning per share. Now, for the value of shares, other things is constant. This is how we read ceteris paribus, which is actually a Latino word. So, other things constant, borrowing will increase earning per share. However, this isn't source of value to shareholders. Generally, when the company borrowed money, this actually will increase the earning per share. But we know when we increase the earning per share, this will not increase the value of the company. And actually, shareholders or investors can easily replicate the firm borrowing in their own if they choose. So they don't need the company to borrow for them. If I am an investor, I can borrow more money and invest in more firm instead of asking my company to borrow money and invest and generate more money. So I mean both of them same, okay? This is how they argue. Okay, now the next questions: how borrowing affect risk and return? Did financing does not affect the operating risk of the firm? Okay, when we say operating risk, this is the risk in firm operating income. So when you use debt, which is loans or bonds to finance your activities, this will not affect your operating risk. What do we mean by operating risk? This risk related to the nature of the company. Like, for example, if your company is about oil and gas, definitely anything that affects the price of oil and gas will affect you. And any accident that happened in the side will affect the company. We call it operating, but nothing to do with debt financing. Debt financing will only affect the financial risk. So always link debt financing affect financial risk of the company. Okay. The company will become riskier when they take more loans, but this will not affect their operational risk. Now, when we say financial risk, this is the risk to shareholder resulting from the use of debt. If the company took too much debt, this represents a risk for me as an investor, because there will be a high risk, right? The company will collapse if the company cannot pay the debt because they are taking too much debt with the interest rate. This will affect the performance of the company. So for me as a shareholder, I will be worried if the company take too much debt. So this is how borrowing affected risk and return. Okay, borrowing will affect the company only financial risk, and definitely this will affect the return, because if the company take more risk, it means they invest in more projects and they will have higher return. Now, to summarize, till now, we said borrowing does not affect the value of the company. Borrowing will increase the earning per share, but this actually not affecting the value of the company. And the last one, borrowing will affect the company risk. The company will be more riskier in terms of financial risk, and this definitely will increase the return on our investment, because they will have a bigger amount of money. They can invest it more and generate more income. Okay. In the previous slide, we said borrowing affect risk and return, and in this slide, we will explain it more. So, what do we have here? We have in the first line in the slide in front of you, those two circles represent the firm value. Let's start one by one. The first one, the orange circle, assume here we have one company that is all equity financing. Okay, so this company, they use only shares to raise money to invest and operate the company. In this case, we call it all equity. Assume the value of the company in this is this circle. Okay, this is a value, and this is all orange because it is all equity. Now assume they decide to restructure the capital structures, and now they want to use, instead of 1 million all equity, they want to use 500,000, half million from debt and half million from equity to finance their activity. In this case, we will have the second circle, half of it green, which is debt, let's say, and the other half is orange, which is equity. So, what is the idea here? The idea here, whether you use all equity or half debt and half equity, the size of the circle is the same. So the circle is not becoming bigger or smaller. We are the same. We just distributing the circle halfly. This is what they said and M propositions. Whether your firm is all equity or half and half, still the value or the size of the circle will be the same. Now, let's talk about expected return. The second line in the slide, if the company use all equity in the blue circle, assume there are operating income. When we say operating income, this is the income from their work, okay, from their core operations. Okay, if their income is 125,000 before restructuring, after restructuring, the last circle, actually, they will have less equity income here. This is just actually hypothetical example. I mean, the number we just put it assume here. Okay, the company paid 50,000 for debt interest because remember, when you apply for loan, you need to pay debt interest, and this will reduce the remaining income for shareholder. Okay, in a blue circle, you are receiving 125,000 income. Now, in other circle, you cannot receive all of them. You need to pay for the bank some payments, right? The remaining will be for you. So actually, the expected income will be lower after taking debt. Now let's move. So we are done with the propositions one. We will move now to propositions two. But let's talk about debt and cost of equity. If you take more debt, how this will affect cost of what? Of equity, which is cost of shares and other things. Actually, don't worry about the first equation in the slide because from this one we derive the next one, okay, which is the important one. So those guy M and M, they also proposed these equations. They said R means cost or return. It is the same. The expected return on firm's equity equal to expected return on firm assets plus D divided by E. D is the amount of debt. So from the name D, debt, as a dollar amount. Like how much did you have in the balance sheet? You divide it by equity, which is how much you have in the balance sheet, multiply by R assets minus R debt. So this is what they said. This we call it M and M proposition 2. So they say here uh, the required rate of return on equity increases as the firm debt to equity ratio increases. So now look to the left side in the formula. R minus required, the rate of return. So return for equity or for shares will be equal to return for assets plus something. This plus this extra is because of using debt. Now, ignore the equation for now. Let's think on it, okay? If I am a visitor in a company and this company apply for a loan, take more loans, then I will try to ask for higher return for me because the company now is riskier, right? If they don't give me high return, I can go to another company who are lower risk or have lower risk. So this is the idea here. When the company take more debt, it means the company now is riskier. And as a shareholders, I will ask for more return to compensate me for this risk. So in this case, we can calculate our return for shareholder like this equation. Okay, it is equal to the return for assets plus this extra in the equation here. That's why we said that the required rate of return for equity or shares will increase because the firm now they use this amount debt and equity. Here we have example, what is the expected return on equity? So the question is actually here clear. Expected return for what? For equity. For a firm with 14% expected return on assets. So the expected return on asset, they give it to us 14%, base 9% in debt, which totals 30% of assets. Okay, so here we have 14% return on assets, 9% debt. Now we need to know how much they have debt and how much equity. Now, this is tricky. What they said here, the amount of debt equals 30% of assets, like the debt is 30% of assets. So the debt is 3, from 30%. The remaining is will be a 7, which is a 70%, because we know debt plus equity should equal total assets, right? If total assets 100% and 30% is debt, the remaining will be equity. So 3 divided by 7 here, and this will give you our equity. Again, we continue in M and M propositions too. So when we say to you, or maybe we ask you theory, what is M and M proposition 1? What is M and M proposition 2? So remember this one. Propositions 2, debt increases financial risk of the company and causes shareholder or visitors to demand a higher rate of return. And you can see this formula in the slide. The required rate of return for shareholders will be at least equal assets plus something. Okay. Now we have a graph also here that explains this issue. So what do we have here? In the y-axis, we have rate of return. In the x-axis, we have the amount of debt divided by equity. Like for example, point one here means 10% debt only. We use 20%. That's 30%. So as we move to the right, okay, the amount of debt is increasing, right? What is the idea here? The idea, assume this green line represent the cost of debt, and assume the cost of debt is 10. Like, think on it. If you want to go to apply for a loan, they will charge you 10%, the amount of interest rate for the debt. Okay, this blue one is the return on assets. Assume the return on the cost of assets is 12%. Now, for me as a shareholder, I am the only, actually, the orange one, okay, here for shareholders. I will ask for more than 12. I will not ask for 10. 10 is low for me, okay? Not 12 as well, okay? Not 12 even. I will ask for me, as I said here on the left side, you will ask at least equal to assets plus something. So you will have this orange line like this. It will go up. So the amount of equity here at least equal our assets from this equation. Plus there is also amount of debt. So the highest one is what? Cost of equity. And this is what they said. Shareholders will ask for higher rating. This is the orange one, above the assets and above the debt. Now, until now, we finished propositions 1 and the propositions 2. Proposition 1, they said there is no value from using debt. It is the same. Propositions 2, they said when you use debt, this will increase your rate of return for shareholder. Now, in real life, we know there is a tax, right? So, let's just relax the assumptions, assume there is a tax, and how this will affect the theory we just finished. Debt financing advantage. There is here some debt financing advantage for taxes. Why? Because the interest that a firm is based on a debt is tax deductible. So, for you as a firm, when you apply for a loan and take loan, you are going to pay interest on this loan. The interest expenses, you can deduct it from the tax. So for the corporations, when we calculate the tax, we remove first the expenses. And one of the expenses is the interest rate expense. So think of debt as a good thing. When you take a loan, it means you will be more interest and you will pay less tax, and you can use the loan to do many projects, right? So this is, we call it interest tax shield or interest tax saving. When you use debt, you will save more tax, you will pay less tax. And this is the equation in front of you. The yearly tax shield or saving is equal to tax for corporations, the amount of tax multiplied by you open a bracket, okay, the cost of debt multiplied by the amount of debt as a dollar amount, which is mentioned in the slide. So T means corporate tax, R multiplied by D. This is the interest payments. Normally for corporations, the tax they pay 30%, but it's depend actually in different. It is difference between the countries. I mean, every country have their own taxes, right? Normally they mentioned actually in the question. So anyway, we know now when we use debt, we are going to save this amount that I highlighted in the orange color. Like if you multiply these two numbers, this will save you tax. Now, assume this tax saving is perpetual, will go forever, as long as the company using it. We will keep receiving tax saving. If you want to calculate the present value of this tax saving, because the tax saving will come over many years until infinity, if you want to calculate the present value, there is a formula present value for tax saving. It's equal the annual tax shield, which we calculated in the previous slide, if you remember, divide by R of debt. So this is the equation for it. So this is the formula. They derive it. The final formula is the 1 T multiplied by D. I highlighted in orange color. Now we have one example here. What is the present value of tax shield for a firm that anticipate a perpetual debt level of 12 million at an interest rate of 4% and tax rate of 35 million? Okay, read the questions again. We need the present value of tax shield. Okay, so which is here T multiplied by D, right? It is equal to the amount of tax which is mentioned in the questions. So the company is paying 35% multiplied by D, which is basically 12 million. So the amount of debt is 12 million. They are going to save now $4,200,000, which is good. Imagine if the company used 12 million debt, like they took a loan for 12 million, they will save $4,200,000 from tax. But this is assuming this will go forever, right? Now we will go to another propositions. We call it again a proposition one, but this is M and M2. Okay. So what we covered before is here. Um, yeah, here. Proposition 1, M and M1, right? So those guys, they have two theory. The first one called M and M1, right? And this there is one suggestion. And the another suggestion, it is here, right? There is, okay, another propositions, which is suggestion 2. But still, this is related to M and M1, right? So here, now, here we have M and M2. Then the first adjustments. I think this theory, they do it after 10 years from that one. So after 10 years, they discover it. Okay. There is another theory. What they said here, when accounting for taxes, if we take into consideration the effect of tax, then borrowing increases the firm value and shareholder wealth. So at the beginning, they said there is no value when you use debt, right? This will not increase the value. But then in the propositions too, they said no, borrowing will increase the firm value if we take into considerations the amount of tax, because we said here tax will save you some money, right? If you take debt, this will save you some money. So here there is a new propositions. What uh, they said the value of leverage firm, which is VL, equal the value of unleveraged firm. the one that use equity, plus there is something, plus the present value of tax saving. So now we cannot say this anymore, which is we here what we in this take it in this propositions, VL equal VU. This one is wrong, right? We cannot say this equal to this, right? So here the value of leverage is equal to value of unleverage plus something. So the right side is bigger now, right? So the value of the leverage firm will be higher than the value of unleveraged firm. If you want to go through the concept, which is talk about taxes and wax. Wax, which is covered in other unit. Wax is a cost of raising money from different sources. Wax is weighted average cost of capital. So weighted average means that how much proportions of debt and how much proportions of equity. Yes. So how much weight to debt and how much equity, right? And if we calculate based on that ratio, we calculate how much is the cost of debt and how much is the cost of equity. You will get the total of capital for the firm. So think on it like this. If the company use a mix of debt and equity to finance their activity, at the end, the average cost will be lower, which is good, right? Because the debt here will save us some tax. That's why in real life, most of the companies, they use debt and equity to finance their activities. You will never see a company that use only equity to finance activities or only debt. Impossible. They always use a specific percentage from debt and a specific percentage from equity, and they finance their activity. Why? Because this mix will give them a magic mix that reduce the wax. Okay, this is like this will reduce the wax because cost of debt is very low when we consider tax. Okay, let's see this example. What is the expected return on shareholders if the firms have 35% tax rate, 10% of interest paid in debt, 15% wax, and 60% of debt ratio? We have in the slide this equation for wax. Just put the numbers and you can solve the algebra and calculate it, right? At the end, you will find the return of equity equal 27.7. So you need just to play with the equation, okay? This will give you a 27.7 0.75. Now let's move to M and M2 propositions 2. Okay, so this is 2, but the second suggestion of 2. What they said visitor factor the potential for future distress into their assessment of the firm value. In proposition 1, the previous one here, they said borrowing is good and this will increase the value of the company, right? Which is right. But they said also when the company take more and more debt, they will reach a point where the company will be at a high risk. The company will collapse. There will be not enough to pay the interest rate or the payments for the loan. In this case, investor will ask for higher return because they think the company is higher and higher and the value of the company will be reduced. It will be reduced by the amount of risk here, which is the cost of financial distress. So now the last propositions they proposed here or suggestions, this is the overall market value of the company. It's equal to the value of equity financed firm plus the tax shield, the one we just covered. They said minus you need to deduct the cost present value of the cost of financial distress because there is always cost when the firm collapses or liquidated or goes bankruptcy. There is always some cost, some legal costs, some requirements costs, And think on it. When the company announce, for example, they are going to collapse, the value of the company goes down. Okay, so it's go down by this amount, by the value of financial distress. So what we get from these discussions? Propositions 1 and 2 of M and M1, then propositions 1 and 2 of M and M2. Here, what they said. There is always a trade off between two things. Debt level are choosing to balance interest tax shield against the cost of financial distress, which means for me as a manager, the best way is to use debt, but not too much. There is a point I should not pass it. Okay, always when I take a loan, I take specific amount of debt. Definitely, we don't know what is this a point. Like each firm, they have their own calculation and they find that point. So every firm or every industry, they have something called optimal or best capital structures. So they try to find what is the best mix of debt and equity. So for us, debt is good because this will save you a tax. But at the same time, too much debt means there is some cost here, financial distress. So we need to be careful. This is a trade-off between these two things. So at some point, additional borrowing cause a problem, cause a probability of financial distress or a collapse. And this will cost us some money. So we always try to find the good point. And here we put it in the graph. If there is a possibility of bankruptcy, the current market value of the firm will be reduced by the present value of court expenses. Normally, when the company collapses, there is some expenses, right? Court expenses. We need to pay it first. So this will reduce the firm value. And in the graph, you can see the firm value was up, the orange line. Now it will reduce here by amount of the financial distress between the orange and blue lines. So there is a difference, and this is the present value of financial distress. What does that mean? That the bankruptcy is also increased. Okay, let's talk now about the financial distress, but without bankruptcy. So the company doesn't collapse, but still there is some financial distress or a problem in the company. Even if a firm normally escapes bankruptcy, even if the firm survives, this doesn't mean the cost of financial distress are avoided. So stockholders may be tempted to play a games at the expenses of creditors by beating the bank's money and not beating your own money. So the idea when the company have too much debt and they reach a point they are going to collapse, but they didn't collapse. So what they will do? The shareholders or the investors, they will ask the company to invest in riskier project because they know like if the company collapse, they are going to lose their shares, right? So they will take more risk just to make more money before they collapse. So they will ask to do more risky activities on the expenses of bank loans or the debaters. Okay, so the idea here, there will be a game here. Okay, when the company is it a financial distress. Normally, in real life, shareholders through the manager and different board of directors, they take more risk because they want to survive. They take difficult decisions to survive and they will invest in riskier projects to have return. They may succeed, but they may not. But this will affect actually whom? The banks who give them loans, right? So one way to stop these games is to put something called loan covenant. This is agreement between the firm and the bank, requiring who? Requiring the firm to fulfill certain condition to safeguard the loan. So the bank, they are clever, okay? They will put some instructions when you take a loan. They will put some restrictions in the agreement. Like for example, you cannot invest in risky investment. You cannot invest in your projects unless you pay the loan or something like this. Okay, we call it loan covenants. Okay, now we are done with the discussions for M and M propositions. It is a bit tricky, but you need to remember all of them. Okay, it is easy. Summarize it. What M and M1 proposition 1 said, what M and M1 proposition 2 said, then the same for M and M2 proposition 1 and M and M2 propositions 2. Now, the end here, the last few slides, we will talk about financing choices. In real life, how financial managers choose between debt and equity. There is two famous theory. The first one called the thread of theory. Debt levels are choosing to balance interest, tax saving against cost of financial distress. So normally, manager they try to find what is the best level of debt that allow me to have some tax saving that is bigger than the cost of financial distress. So always I want the tax saving from interest to be higher than the cost of financial distress to make some money, okay, to do some benefit. So they will try to find this point. The other one called a pecking order theory. Firms or company prefer to issue debt rather than equity if internal financing is insufficient. So what's the idea here? From the name, pecking order. Manager, when they raise money, if they need money to invest in a new project, they first use their internal fund. We call it return earnings. So they will try to find or to use their profits from last year. This is the best options like for me because it is for free, right? So if I have projects, I use my own profit from last year. But if this profit is a small and I have a big project, then the next options, the next order. So the first order should use your own internal fund, which is this one. If this not sufficient, you issue debt, which is bonds or loans. Then the last one, use equity. So we call it order theory. So you need to remember this. The first one is internal fund. Second, best option for me is debt. Third option is equity because equity is very costly. Okay, let's talk now about a financial concept called financial slack. Financial slack, it means ready access to cash or debt financing. So, financial manager usually place a very high value on having a financial slack. So, what's the idea here? If the company have too much cash, this encourage the manager or the managers to misuse the cash because they have enough money. They will start using it for unnecessary expenses. They will use it for whatever going on travel, using business classes. They may buy specific cars for the company, luxury cars, and so on. This is, we call it financial slack. If you have enough money, too much money, I mean, this is not good for the company, okay? Okay, here actually we will talk about this one. There is two phases for the financial slack. There the benefits. Long run value reset more on capital investment and operating decisions than on financing. So if I have too much cash, then managers will focus their time and effort in the investment rather than on how to bring the money because they already have the money, right? If they already have the money, they focus more in the investment and operating decisions. So this is good sometimes when you have too much money in the company. Most valuable to the firm with positive MBV growth opportunity. Also, if you have enough amount of money, this is good. If you have some good projects, you call it positive MBV growth opportunity. If you have good opportunity to invest and the money is ready, you can go quickly in the market and invest, right? So this is good. This is the benefits. And drawbacks, as I said, too much financial slack may lead to lazy management. If you have too much money, then management will feel lazy because they already they are in a good positions. Managers may try to increase their own perks or engage in empire building. If you have too much money as a financial manager, you may start investing in projects that are unnecessary just to help yourself or to build a big company and to say, I am a president or the manager of a big company that have many branches. But we know those branches they are doing a loss. But you want to build it, or you may open a new branches in your village or your higher relatives, your relatives on the branch, and so on. So too much money will encourage many managers to invest more, open more branches to hire their empire. Okay, this is all. So in this lecture, we discussed the debt policy, whether it is good or not. To use debt, you need to know the propositions. Then at the end, we know debt is good as long as the tax saving from the debt is higher than the cost of financial distress. Thank you very much and study well. Assalamu alaikum wa rahmatullah wa barakatuh.